Good day, everyone. Today, our group Receivables will be discussing the basic assumptions of accounting.
Why do we need to be aware of the basic assumptions in accounting? The assumptions are used as the foundation for accountants to be consistent and reasonable with their data.
This is also to make sure that financial statements can be comparable from past and future. Now that we have discussed the importance of this topic, we can now move on to the 7 types of assumptions.
The first is accrual or money measurement assumption. This is when the business would record their profits and expenses even if the transactions are not yet complete, which means that even if the company would receive or give money on a later date, in the records, it would be recorded as either a receivable or a liability. If the assumption is false, a business should use the cash basis of accounting to develop the financial statements that are based on the cash flow.
The opposite of this is the conservatism assumption. This means that the company will only record the transactions when the money is already given or received. The problem, however, with this is that records could be inaccurate with dates of the transactions. This also makes the company have no receivables and liabilities on record. If assumption is false, however, the business may be issuing overly optimistic financial results. In line with both of the previous assumptions, though, is the reliability assumption. This is to note that all transactions recorded must be legitimate and have a high chance of success. This is also to make sure that the company is not making fake transactions to give the appearance of success. Next is the consistency assumption. This refers to the fact that all financial statements should have a consistent method for creation and analysis. This also makes sure that the data is comparable with the past and future statements. New accountants must also follow their predecessor steps. The only reason why these methods would change is when a better one is applied. And if assumption is false, the financial statements produced over multiple periods are probably not comparable.
Another assumption in line with this is the time period assumption. This is so that the financial statements of the company are done in the same duration. Such as if they are done quarterly, then it should be consistently done quarterly. Same with that, it would also start on the same time. So if the fiscal year starts on January, then it would always start on January. If this is not the case, financial statements will not be comparable across reporting periods, same as an accounting period. The next is the economic or separate entity assumption. This is to say that the owner and the business are different and their finances should not intermingle. So the owner cannot spontaneously withdraw money from the business and use it for personal use. And they can also not add money without putting it as capital. If assumption is false, it is impossible to develop accurate financial statements.
Going concern is the last of the 7 assumptions. This refers to when the business should continue to operate for a foreseeable future. If the assumption is false, then it's likely the shutdown of the company is probable and that all liabilities and tasks should be completed.
These are all the basic assumptions of accounting, and we hope that you were able to understand them all. Thank you.